Welcome to the second part. To understand the falling rupee, you must first understand the world it falls in, a world designed by design or by accident to ensure that one currency above all others remains supreme, the US dollar. Section A. Why the dollar rules the world. The dominance of the US dollar is not an accident of economics. It is an outcome of war, diplomacy, and extraordinary strategic design. It begins in July 1944 in Bretton Woods, New Hampshire, where 44 allied nations gathered to design the post-war global economy. The United States, emerging from the war as the world's largest economy and the holder of two-thirds of the world's gold, negotiated the creation of the dollar as the global reserve currency. Every other currency would be pegged to the dollar. The dollar would be pegged to gold at $35 per ounce. This gave the United States what French economist Jacques Rueff called an exorbitant privilege, the ability to print money that the entire world would accept. In 1973, after Nixon ended the gold standard, the US negotiated a second masterstroke, the Petrodollar. An agreement with Saudi Arabia, OPEC nations would price all oil in US dollars. In exchange, the US would guarantee Saudi security. The result? Every country on earth that needs oil must first acquire US dollars. India, importing 85% of its oil, must earn or borrow dollars just to keep its lights on and its factories running. This is the structural foundation of dollar dominance, not superior economics, not superior governance, superior geopolitical engineering. USD share of global reserves 57.3%, down from 72% in 2001. USD share of global trade settlement approximately 45%. USD share of international banking approximately 55%. USD share of global debt issuance approximately 60%. No other currency is even close. EUR 20%, GBP 5%, JPY 6%, CNY 2%, INR 0.1%. Section B. America's strategic view of the rupee. America does not want the rupee to fail, but America also does not want the rupee to threaten the dollar. This is a delicate balance, and Washington manages it deliberately. On one hand, the United States wants a strong India as a strategic counterweight to China in Asia. A strong India needs a somewhat stable rupee. On the other hand, when the Fed raises rates and capital flows to the dollar, the US government does not intervene to protect the rupee. It is not obligated to, it never agreed to. The 2025 episode illustrates this perfectly. Trump imposed 50% tariffs on Indian exports, specifically targeting India's energy trade with Russia. The rupee fell 5.5% in 2025, Asia's worst performance. The US government's response? Silence. America's message to India is clear. Align more closely with us, economically and strategically, or pay the currency premium for independence. This is soft power through forex markets, and it is devastatingly effective. Section C. China's Yuan strategy versus India's rupee. Now consider China. In 2001, the Chinese Yuan, renminbi, had essentially zero presence in global forex reserves. Zero. Today it holds 2% of global reserves, still small but growing. More importantly, China has built a comprehensive infrastructure to internationalize the yuan. CIPS, Cross-Border Interbank Payment System, China's alternative to SWIFT, now processes $13 trillion in annual transactions. Digital Yuan, ECNY, already processed 7 trillion Chinese yuan in transactions by June 2024. India's e-rupee, a barely visible 100 million Indian rupees by comparison. Belt and Road Initiative, 140 plus countries. Loans denominated in yuan. Trade settled in yuan. China is building a yuan-denominated sphere of influence, one infrastructure project at a time. Petro-yuan, Saudi Arabia and Gulf states are now increasingly open to pricing oil in yuan. If even 20% of global oil trade shifts to yuan, the dollar loses its greatest structural advantage. China's yuan share of global payments, SWIFT, 3.6% India's rupee share of global payments. SWIFT, less than 0.5% China's ECNY digital currency adoption. Leading globally, India's e-rupee adoption. Nascent minimal number of countries using yuan for oil settlement. 8 plus number of countries using rupee for oil settlement. 3. Russia trade. China is running a 20-year internationalization strategy with the full weight of state resources behind it. India announced an internationalization of the rupee roadmap in 2023. The roadmap exists. The execution infrastructure does not. In the currency power game, America owns the present, China is building the future, India is still writing the plan. Section D, the geopolitical conclusion. Here is the fundamental geopolitical reality that every Indian citizen must understand. The rupee does not fall because India is poor. India is not poor. India is the world's fifth largest economy. The rupee falls because the global monetary system was not designed for India's benefit. It was designed in 1944 by Western powers for Western interests, and India, a nation that was colonized until 1947, entered this system as a debtor, not a designer. Every major depreciation episode has been triggered by forces India does not control. Fed rate decisions, oil price shocks, dollar weaponization, US tariff policy, global risk off sentiment. This is the true hidden fact of the falling rupee. Not incompetence, not corruption alone, not any single government, it is structural. It is geopolitical, it is historic. And to change it, India must do what China began 20 years ago. Build the alternative, not just talk about it. A question that haunts every serious Indian economist: why does India, the world's fastest growing major economy, have one of Asia's worst performing currencies? Let us benchmark India against its peers. In the year 2000, if you converted all currencies to an index of 100, meaning each currency starts at the same baseline. Here is where each currency stands in 2025. The Chinese Yuan, index value 132. It has strengthened against the dollar by 32%. China ran consistent trade surpluses. China built manufacturing dominance. China controlled inflation tightly. China aggressively managed its currency. The Singapore dollar, index value 116. Singapore, a city of 6 million people, has a stronger currency than India in relative terms. Why? Zero corruption tolerance, world-class governance, trade surplus, capital account management. The South Korean won, index value 85. Even Korea, which faced the Asian financial crisis devastation, has depreciated far less than the rupee. The Indian rupee, index value 51. India's rupee has lost 49% of its relative value against the dollar since 2000. Pakistan's rupee, index value 10. India performs significantly better than Pakistan. Brazil's real, index value 38. India performs better than Brazil. This is important context. India is not the worst, but India is far from good. The China comparison, the most important contrast. The China-India currency comparison is perhaps the most revealing and most painful analysis for Indian economic strategists. In 1990, the Chinese Yuan and the Indian Rupee were at roughly similar levels against the US dollar. By 2025, CNY 7.2 rupees per US dollar, approximately having peaked stronger at 6.04 rupees in 2014. INR 90.43 rupees per US dollar. The yuan has appreciated, the rupee has depreciated in the same global economic environment over the same 35 years. Why? 5 key reasons India went backward while China moved forward. Reason 1, manufacturing versus services. China built the world's largest manufacturing base. Manufacturing creates goods that are exported. Goods exports earn foreign exchange. Foreign exchange earnings support the currency. India built a services economy, primarily IT and software. Services exports are significant, $340 billion in FY 2025. but they are more volatile and less trade balance friendly than China's $3.5 trillion in goods exports. Reason 2, trade surplus versus trade deficit. China runs a consistent trade surplus, more export earnings than import costs. Net dollars flow into China. The yuan is structurally supported. India runs a consistent trade deficit, more import costs than export earnings. Net dollars flow out of India. The rupee is structurally pressured. This single difference, surplus versus deficit, is perhaps the most critical determinant of long-term currency trajectory. Reason 3, capital controls. China maintains strict capital controls. Foreign investors cannot move money out of China at will. This protects the yuan from speculative attack. This was Soros's lesson in Hong Kong in 1998, when a government with sufficient reserves and controls defeats speculators. India has moved toward a more open capital account. More openness equals more vulnerability to capital flight. In global crises, this openness becomes a weakness. Reason 4, manufacturing self-sufficiency. India imports 85% of its oil. India imports 90% plus of its defense equipment by value. India imports most of its electronics and semiconductors. India imports gold voraciously, 800 to 900 tons per year. Each of these imports requires dollars. Each dollar spent on imports equals pressure on the rupee. China, after decades of strategic industrial policy, has dramatically reduced import dependence in many key categories, that is the currency advantage. Reason 5, Forex Reserve Policy. China holds $3.2 trillion in foreign exchange reserves, the world's largest by far. These reserves are a shield against speculative attacks, against currency crises, against external shocks. India holds approximately $680 billion in reserves, significant by emerging market standards, but proportionally smaller relative to GDP and import exposure. And the RBI spent $36 billion of those reserves just in H2 2024 to manage the rupee's fall. The honest verdict: India is not going backward in absolute terms. India's GDP has grown from $500 billion to $3.9 trillion since 2000. India's poverty rate has fallen dramatically. India's infrastructure has improved substantially. India's digital economy is world leading. But in currency terms, relative to its peers and its potential, India has underperformed. The rupee tells a story the GDP numbers don't. A country that is growing fast but consuming more than it produces, importing more than it exports, borrowing more foreign capital than it generates domestically. A currency is a nation's balance sheet, and India's balance sheet, in currency terms, shows a structural current account deficit that decades of growth have not yet resolved. This is not a political statement, it is an accounting identity. Imports greater than exports equals currency pressure. Full stop. We have traced the rupee's history. We have dissected its weaknesses. We have placed it in geopolitical context. Now comes the hardest question. Where does the rupee go from here? I will give you three scenarios. All three are supported by current data and credible analysis. None of them is guaranteed. All three are possible. Scenario 1, the bear case, 100 to 115 rupees by 2030. Probability 35%. Structural problems persist. This scenario unfolds if US India trade tensions escalate further under Trump. 2.0 50% tariffs on Indian goods remain or worsen. The Federal Reserve maintains higher for longer interest rates into 2027, sustaining dollar strength. Global oil prices spike above $100 per barrel due to Middle East conflict or OPEC plus production cuts, exploding India's import bill. India's current account deficit widens beyond 2.5% of GDP. FPI outflows continue. Indian equity valuations remain stretched relative to China's stimulus backed recovery. Under this scenario, wallet investor, USD INR reaches 93.2, 1 in 2026, 103.57 by end 2030. Traders Union USD to INR could reach 107 by end 2029. Consensus bear case 100 to 115 rupees by 2030. The rupee breaks through 100 rupees, a psychologically critical barrier, triggering panic, accelerating inflation, and creating the very conditions that feed further depreciation. This is not apocalyptic. India has survived every previous low, but the social and economic cost is significant. Scenario 2, the base case 93 to 101 rupees by 2030, probability 45%, the most likely trajectory. This scenario unfolds if current trends continue moderately. The RBI maintains managed depreciation of 2 to 3% per year, consistent with inflation differential. US-India trade deal is eventually signed, reducing tariff pressure. India continues attracting FDI with new semiconductor plants, Apple supply chain shifts, and GCC expansion. JP Morgan and Bloomberg bond index inclusion brings $20 to $25 billion in additional inflows, partially offsetting FPI exits. Oil prices remain in $70 to $90 per barrel range. Under this scenario, the normal annual 2 to 3% depreciation continues. The rupee gradually moves from 90 rupees today toward 95 to 101 rupees by 2030. This is the managed decline scenario. The economy grows, the rupee weakens slightly, life goes on. India manages its currency the way it always has, not by fixing the structural problems but by managing their consequences. Kotak MEF forecast: on a normalized basis, given that India runs a current account deficit, the expectation is of depreciation by 2 to 3% annually. Scenario 3, the bull case, 75 to 85 rupees by 2030, rupee strengthening, probability 20%, requires structural transformation. This scenario requires a genuine paradigm shift. US-India Comprehensive Trade Deal signed by 2026. Tariff rollback to 10 to 15% on Indian goods. India's exports surge, software, pharmaceuticals, textiles, EVs. India achieves oil import reduction through ethanol, blending at 20%, already underway by 2025. EV adoption hitting 15 to 20% of vehicle sales. Strategic petroleum reserve usage reducing spot market pressure. INR internationalization gains traction. 10 plus countries use special rupee Vostro accounts for bilateral trade. India, UAE, India-Russia oil settlements in rupees become significant. RBI builds INR liquidity support framework. The Federal Reserve cuts rates aggressively in 2026 to 27. Recession concerns, weakening the dollar. Capital flows to emerging markets. India benefits disproportionately. India's manufacturing exports accelerate. Apple's full India supply chain becomes operational. Made in India electronics exports triple. Trade deficit narrows to 1 to 1.5% of GDP. Under this scenario, ING Bank forecast USD/INR strengthens to approximately 87 by end 2026. AI pickup algorithm USD/INR at 78.35 by 2030, rupee appreciates. Westpac USD/INR at 76 to 77 by end 2027 in aggressive Fed cut scenario. India's GDP has grown from $30 billion in 1947 to $3.9 trillion in 2025, a 130-fold increase. The rupee tells you the relative story. The GDP tells you the absolute story. Both are true simultaneously. The honest verdict is this: India is a growing giant with a structurally weak currency. The weakness is real, the growth is also real. One does not cancel the other. But the gap between India's economic potential and currency reality will only close when India builds what it still lacks: a manufacturing base that earns more than it spends, an energy base that does not require 85% imported oil, a capital market that can retain, not just attract, foreign investment, an internationalized currency that is used, not just talked about. China spent 30 years building these things. India is beginning to build them now. The rupee's future depends on how fast that building goes, not on the RBA's intervention strategy, not on the Fed's next move, not on what happens to oil prices next quarter, on the fundamentals, always the fundamentals. The question mark belongs to India. To answer it is the work of the next generation.